Hi everyone. Welcome to our second webinar series. So this second webinar will give you an insight on why you should consider equity unit trusts. And I would like to introduce Surat, who is the Chief Investment Officer of Centfin Asset Management, and Surat will take us through on why equity unit trusts are good to invest into. So without further ado, over to you, Surat.
Hi, good evening all. So we are in the second episode of our webinar series. Initially, we had an introductory session on what is unit trust. Today, we are going to speak about why you should consider equity unit trust. So let's get started. I have a presentation, so I will share it and we will take it from there. Okay. Hope all of you can see my screen.
Yes, yep, we can see Surat.
Okay, thank you. So today we are here for why you should consider equity unit trust. First of all, what is a unit trust? So unit trust is a formal investment structure where funds from multiple investors are pooled together. So it's a pool of funds where let's say investor A, investor B, and investor C of different amounts. Let's say investor A has 10,000 rupees, investor B has 1 million rupees, investor C has 500,000 rupees. So all pooled together, and the fund manager will invest in a diversified range of securities such as equities, treasury bills, treasury bonds, and money market instruments. This pool fund is known as the investment portfolio and is professionally managed by the fund manager. So these unit trusts are governed by Securities and Exchange Commission of Sri Lanka, and there's a trustee to each unit trust. So basically, because the unit trust manager or the unit trust does not own the funds basically. So investor A, B, C, or whoever invests in the pool of funds, the ownership of that fund will be under the custody of the trustee, which is a renowned bank. So in our case, at Centfin Asset Management, all our funds trustee is HNB. Moving forward, so this is the setup of a unit trust operation. Onto your left hand side, the investors, or we call them unit holders. So unit holders will invest in this common pool of funds, which is the unit trust, and we have the trustee who is overlooking this fund, because all the transaction will go through this trustee. If you invest in this unit trust, you have to send funds to HNB. There will be an account. So for an example, if you invest in the Centfin Growth Fund, there will be an account dedicated at HNB head office for this particular fund. So you transfer fund to that. Then on the fund management side, on the unit trust manager will create an account for you. Then when it comes to your before that, so this pool of funds will be invested by the fund manager in different instruments. So if you take an equity fund will be investing mainly in Colombo Stock Exchange listed equities. So for that also, we have to go to the trustee. The fund manager will take the decision and execute the transaction. Then the fund manager needs to inform the trustee that we bought these shares, so please do the settlement. So all the transactions are run through the trustee. Then we have on the right hand side, which is the regulator. For the unit trust manager, that is the company, Centfin Asset Management, has to be licensed by the SEC, as well as for each fund there is a license to be obtained. So all funds will be licensed under SEC. So this is the basic structure. So we are moving forward to what is an equity unit trust. So equity unit trust is a pool fund once again that invests primarily in equities of various companies, offering investors a diversified portfolio and potential for capital growth, and it is managed by professional fund managers. So it's a unit trust mainly invest in equities. In Sri Lankan context, it's the listed securities of Colombo Stock Exchange. So unit trust broadly classified into two categories: open-ended and closed-ended funds. So open-ended fund means it's more than 90, almost all the funds in Sri Lanka are open-ended funds. Open-ended funds means you can you can invest in the fund at any point, and you have the ability to withdraw from the fund at any given point. So that is the normal structure of an open-ended fund, and we in Sri Lankan market almost all are open-ended funds. So closed-ended funds are also there. So closed-ended fund means it's a listed instrument. So basically, it's a listed fund in the Colombo Stock Exchange. Similar to a share, it comes through an initial public offering where investors will subscribe for these closed-ended fund units. Then after that, it is listed. So when you want to withdraw, what you need to do is in an open-ended fund, what happens is you withdraw from the fund manager. You go to when you want to withdraw money, you go to the fund manager and put an email request or whatever and withdraw funds. But in a closed-ended fund, if you want to withdraw, you have to sell that in the stock exchange, and there will be there should be another buyer to buy that in the stock exchange. So it's a secondary market instrument. Buying and selling happens in the Colombo Stock Exchange. So on the equity funds, there are several types of funds. I have categorized 5. Growth funds are the main fund. So main fund that is like more than 60% or almost all the funds in this growth category mainly invest in the equities. So high equity exposure. And a certain portion may be left for liquidity purposes when there are redemptions and all. To meet those withdrawals, there will be a certain portion in liquid savings or money market instruments, but mainly invest in the stock market. Balanced fund has some flexibility. So balanced fund means it has the ability to shift between equities and fixed income. So for instance, let's say in a situation where the equity market is doing very well, fund allocation, you can put 90%, 95% of your fund into the stock market. But when there's a downturn, in the market, what the fund manager usually does is liquidate most of them and basically realize profits from those equities you already invested and put those sales proceeds in fixed income instruments. So there is flexibility, and it gives a better return in a situation where markets are volatile, because you can in good times you can invest a high exposure into the equities, and when there's a market downturn, you can withdraw as in sell those shares and put that money into fixed income instruments and preserve your capital. That is a balanced fund. Sector funds are also there. So at Senfin Asset Management, we have 3 sector funds dedicated to those sectors. Financial Services Fund is there, Consumer Sector Fund is there, and Insurance Sector Fund is there. So those specific funds will invest only in those sectors. So for example, financial sector fund will only invest in banks and finance companies. So it's not allowed based on the fund objective. You are not allowed to invest in other shares. Like you can't go and invest. The fund manager can't go and invest in John Keys Holdings to Hemas Holdings or whoever, which are not banks or finance companies. You are not allowed to invest. Then index funds. Index funds are pretty rare. So index funds are pretty much you are managing according to an index. So in Sri Lanka, apart from the ASPI, All Share Price Index, we have the S&P index. So there could be a fund can be created based on that index. So index fund only invest in those companies under that index. So if you have an index fund tracked against the S&P index, you can only invest in those 20 companies which comes under the S&P SL20. Then finally, we have Sharia-based equity funds. So Sharia-based equity funds are dedicated to Sharia-conscious investors, which will be invested according to a whitelist given by the Sharia scholars. So just to give you a background of Senfin equity-related funds, we have 6 equity funds. two growth funds. So Senfin Growth Fund is our largest fund, which is more than 4 billion in fund size. So this two columns gives you the returns which we have given over the last 2 years. 2023, the fund has grown by 34% return, and 2024, 41%. Then we have the dividend fund. So the difference between growth fund and dividend fund is dividend fund focuses more on shares, which gives a moderately high dividend. So that fund, that is also a growth fund, but the stock selection would be skewed more towards dividend paying counters. So in 2023, it has given a return of 26%. In 2024, it has given a 44% return. Then we have as I said earlier, we have three sector funds. Financial Services Fund. 2023, it was not there. That's why the sale is blank. We launched these two funds, Financial Services Fund and the Consumer Staples Fund, in end 2023. So 2024 was the full first year. Financial Services Fund gave a very significant return of 63% over the last 1 year. And Consumer Sector Fund also gave 37% return. Insurance fund is specifically dedicated to insurance counters. In 2023, insurance sector did not have a major run, so it gave a moderate return of 6.32, while in 2024, it gave a return of close to 41%. And also, finally, we have the Sharia balance fund. So it's a balance fund based on Sharia concept. 2023, it gave a 13% return, while in 2024, it gave a 33.72% return. So all of these are open-ended funds. We don't have closed-ended funds from our end. So then we are moving forward to why you should consider equities at this point of time. So why you should invest in equities? You might feel we ran into in January, if you follow the equity markets, it ran into an all-time high of 17,000. Now it has slightly eased up. So I have several points of an investment thesis where why you should consider equities at this point of time. Firstly, we are in a low interest rate environment where your investment options are pretty limited. So if you look at the net returns of fixed income instruments, they largely come down. I have given a basic bar chart. LCB means licensed commercial banks. 1 year FD gives you 5.1 means not the net return, not the gross return. So that is after considering the tax component, because interest income is liable to your tax payments, so it's taxable. It's a taxable income. So if licensed commercial bank 1 year FD on average gives you around 5.1%, whereas 12-month T-bill gives you around 5.3. NBFI means the non-banking financial institute, that is finance companies, a slightly higher return, around 6.2, because usually more than banks and treasury bills, finance companies do give a better return than that. However, that also, if you consider net of tax, your net return would be 6.2. So all the alternative fixed income opportunities will be less than 6.5. So if you look into more longer term investment like debentures, you could get a slightly better return, but then you have to lock in for a longer period. Debentures are about 3 years and above, and treasury bonds are also there. That is also will give a slightly higher return, but once again, it's a long-term instrument. So considering these net returns, equities are expected to give you a better return than this, and these equities are expected to outperform these rates. So that's one consideration. And also the second point is we from crisis level in 2022, we have significantly improved, and at present, our macroeconomic condition is pretty much in good shape. For instance, real GDP growth, if you follow the numbers for 2024, we have given it has recorded 5%, and based on our internal research, we expect the 2025 expected growth is expected to be around 4%, 4 to 5%. Maximum could go up to 5, and minimum we expect around 4%, driven by the low interest rate and improving private sector credit growth. So basically, in a low interest rate environment, it is a motivation for credit growth when you go for credit, and these credit lines are expected to invest in different sectors, and in turn it'll help to assist to increase the real GDP growth. Inflation, at the moment we are in a deflationary stage, but we don't expect it to continue for a long time. Maybe in about 3-4 months time, we might see a positive inflation, but it is expected to remain below 5%. That is the expectation of the central bank as well as the government. So the inflation is expected to be under control. And then the third point, significant improvement in foreign reserves. And 2022, we ran into almost nothing foreign reserve position, and by January 2025, it recorded 6.1 billion, which is a significant growth. And for this year, we expect it to remain high, around 6.5 to 7 billion foreign reserves. Growth in tourism and worker remittance is another big positive. Up to Feb 2025, we have recorded tourism earnings of 768 million, and our target for 2025 for tourism earnings to reach 4 billion, 4 to 4.4 billion for 2025. And worker remittances wise, that also has, as at Feb, it has recorded 16.3% growth year on year, and we expect it to record around 6.5 to 6.6 billion for the calendar year 2025. LKR, that is the exchange rate, it's expected to remain stable. We expect it to maximum around 310. Now it's slightly below. It's hovering around 300. So these are these fundamentally sound the macroeconomy has quite well improved, and it is expected to remain positive in the upcoming medium term. So that is a positive for the equity market. And the CSE earnings growth potential for 2025. So we expect earnings to grow around 15% for 2025 based on our internal research. So this will be driven by the GDP growth. Obviously, when the GDP growth kicks in, the economic activities will improve and businesses will definitely benefit out of that. And then improved consumer demand subsequent to reduced tax rates. So the payee tax habits have been adjusted or reduced down starting 1st April 2025. Also, there have been some increases in public sector salaries. So that will cascade down to more consumer demand, and that will help consumer-driven stocks. Reduced finance costs is also another factor where the interest burden on listed corporates will be low because we are running in a low interest rate environment. Another factor to consider equities would be the valuations. So valuations wise, CSE, we had a growth, but still our market PER remains around 8.32, which is a fairly low number. If you consider the past 10-year average, I think it was around 10 times PE. So we are below the average still, despite the recent growth during not February up to January period. Still, we are at a valuation point of view, we are still at a decent entry point. And when you consider the regional peers also, we have only Pakistan below this 8.32 levels. Other regional peers are P valuations are high. And now moving into the most important section of my presentation, why you should consider equity unit trust versus direct investing. So we spoke about why you should consider equities. Now we are looking at why you should consider equity unit trust as a means of reaching the equity market. So basically, there are two ways to go to the market. One would be direct investing, and the other would be through unit trust. Actually, unit trusts were initially created back in 1990s for the non-complex investors to reach the market who doesn't have equity expertise to reach the market. So these are the points why you should consider equity unit trusts. Firstly, professional fund management. So if you don't have expertise to go to the market and pick stocks on your own, this is the best way, where your funds will be managed by professional and experienced fund managers. So the risk level will be low. Then research-driven decision making. So these are not all the fund managers will be taking decisions on behalf of the unit holders or for the fund after in-depth research. In-depth research on companies and macroeconomy. So we also at Zenfin, we also have an internal research unit. We do our internal in-depth research and take our decisions. So pretty much our investment decisions are backed by in-depth research, which is a positive, where if you directly go to the market, you might not have access to research, as well as you may not have that expertise and time allocation to do your own research. Diversification. So obviously, these portfolios, equity portfolios are well diversified. So the risk, once again, when you diversify, the risk level will come down. Not that the risk is eliminated. Risk is eliminated because anyway, going to equity market has a risk component. But considering if you go individually to equity market and going through unit trust, the unit trust would be the low risk option. Then the next point is small investor friendly. Small investor friendly is for unit trust. Investing in an equity unit trust, the minimum investment is 1,000 rupees. Even if you invest 1,000 rupees, you get access to a diversified portfolio. So if you have 1,000 rupees, if you directly go to the equity market, you can only buy a minimal number of shares. If you buy HNB, you can buy only 3 shares. If you buy Combank, you can buy only 6 shares. So it's a very minimal number of shares you can have by 1,000 rupees. But in a pool fund, even if you invest 1,000 rupees, you are going to get the benefit out of a diversified portfolio because it's a common fund. Then the liquidity. So in unit trust, we had with a short notice, you can withdraw your money. Like usually it's 1 day's notice, and usually it's 1 day's notice, where you can inform via an email request and do the redemption on the next day. But when you directly invest, you don't have that capability, because that's because these unit trust funds maintain a liquidity buffer where the redemptions are promptly met. But if you directly invest, there's a T+2 settlement limit, where when you sell a share today, only on the second working day, you'll be getting the sales proceeds. There's a T+2 requirement as in T+2 settlement in Colombo Stock Exchange. And the security wise, we are pretty much safe way of investing, because we are well regulated by SEC. And finally, the flexibility. So for an example, in our case at Zenfin, we have a fixed income as well as equity funds. So you always have the ability to, we are an email request where you can request the fund manager to transfer funds to transfer in between funds. So for instance, when if you feel the market is peaked and market is going to stagnate, you can ask your unit trust manager to transfer your funds in the equity fund to a fixed income fund like a money market fund where your capital is preserved. So that flexibility will be there, and in turn the other way, vice versa, is also there, where you where your funds are already in a fixed income fund, and if you see the growth opportunity in the equity market, you can swap to an equity fund easily within the same day. You can do that, so that flexibility will be there. So these are the considerations why you should look at equity unit trust if you are going to the equity market. And final two slides, how to invest in Senfin unit trust funds. So the simple methodology would be you can get into our website senfinassetmanagement.com. So we all under funds, you can see all our 9 funds are categorized. So if you want to go to let's say for the growth fund, you pick that growth fund, or let's say dividend fund, you can pick the dividend fund. So under each step there will be fund related documents like past annual reports to fund fact sheets, and everything will be there. And also on downloads you can see the e-forms forms which can be downloaded, so you can fill them and email to us. While the funds can be transferred, it's given on the the investment form. On the other side of the investment form, there will be the account numbers where you can transfer funds to our dedicated accounts at HNB head office and do the send us the transfer slip. So that is one way. And also you can visit our branches in our, there's only one branch, head office, number 80 Bauda Lokamata Colombo 4, and get the documentation done and do the fund transfer. Apart from that, we have the other option of the online portal. So online portal, on the home page, right hand top, we have the create an account. Even if you don't have an investment, you can create the account and then do the fund transfer. So once you go to the create account, then you have to if you are an initial investor, you can go to the no, I don't have an account number tab. So when you go to that, then you can create an account by putting in your email address or even mobile number. You can create the account. Then there'll be a KYC process from our end once you open the account online. Once confirmed, you can do the fund transfer and the documentation. So that's basically it from my end. Hope I was able to give you a good understanding on why you should consider equity unit trust. Now, if you have any queries, you are open. We are open for any questions. So you can, Rahul can coordinate on the questions.
Let's give the participants about 2 minutes to
Sure.
in their questions, and then we'll take it from there, sir.
Yeah, sure.
Right, sir. So we have one question that has come up amongst others. So the first question, so you have covered this more in detail in the presentation, but just to give a quick recap, to few who had joined in afterwards. So, given the current context, stock prices have dropped in price, compared to the last 2 to 3 months we have seen, and the equity market does seem a little bit stagnated. So at this moment, do you still feel like, okay, so basically what can a unit holder benefit from investing into an equity fund at the moment?
Of course, yes. in January 2000, this year January, the equity unit, ASPI got peaked, so it touched 17,000 levels in January, so which is an all-time high. So after that, there has been some selling building up. So because it has been a significant movement from I think for 5 months, starting from August 2024 to January period. Then after that, obviously, some selling came in and markets got slightly weakened from the all-time high levels. So I'd see this as an opportunity because after reaching 17,000, now the market has dropped below 16,000 ASPI. It's hovering around 15, just below 16,000 levels. So this is an opportunity if you didn't have the opportunity to get into the market during this previous run. This is a good opportunity because market has slowed down slightly. So you are able to enter at and you are not entering at the peak level. So you are entering at a slightly lower level than the peak. And as I said earlier, the factors are I explain why you should consider equities at this point of time.
Right. So just a follow-up question to that. Do the unit holders benefit from dividend payouts that companies have been paying in this quarter?
Yeah, of course. The fund will be, as I said earlier, the equity funds will be invested in listed equities. So when these companies which the fund has invested gives out the dividends, those dividend income will be coming to the fund, and that will be reflected in your unit price. So the fund growth, the dividend income is accumulated in the fund. So basically, it gives the unit holder will benefit from the dividend income.
Right. So we have another question. So Sanjeevan has asked, how will I be charged when I sell a unit?
I'll be charged as
So I guess Mr. Sanjeevan must be referring to an exit fee.
okay. For our funds, we don't have an exit fee. So, however, there's a front end fee when you get into the fund. That is a common methodology in all the equity funds in the Sri Lankan market. But we don't have any exit fees. There's no charge. But the management fee once again is a common scenario. That is basically the fund management company's revenue. For management of the fund, there will be a smaller management fee which is charged per annum.
Another question that has been asked is, how can I track the performance on equity funds?
So if you have already invested and created an online account as in that account in our online portal, you can check your balance on a daily basis. Like if you invested 100,000, even if you invest 1,000, you have that access to that online portal. So you can track the performance on a daily basis because it is updated on a daily it's a regular update on the online portal. And also what you can do is, if you don't have the online account, you can track the unit price. So basically, when you invest in an equity fund, there's a buying and selling price. So basically, from the fund manager's point of view, the unit trust point of view, when the customer or the unit holder buys the unit, we are selling at the selling price. And on the liquidation as in when you want to withdraw, it is at the buying price. So from our end, it is the buying price. So when you track the change in buying price, which we publish that on our website on a daily basis, so you can track the performance from that as well. So basically, let's say your entry point, the unit price was 10 rupees, and on a daily basis it has changed, and it has gone up to 12.5 rupees per unit. Then you can track the difference from 12.5 to 10 rupees. That is like 25% gain. So you can track the performance from the difference in unit trust. You don't need to actually look into your full investment. If you track the unit price, that will give the indication of your return.
Right. Thank you, sir. Yeah. So another question. Okay. So this is just more of an overall question. So overall, what sectors are you currently bullish on?
Okay, good question. So looking at the current scenario, I'd say definitely consumer sector would be a sector to look into, because I explained that in the presentation also. Starting April 1st, 2025, pay tax has been reduced, and the pay tax-free bracket has been increased to 150,000. So the tax-free limit has increased from 100,000. It has gone up to 150,000 per month, and also the tax bracket has been slightly reduced. Because of that, the disposable income levels on people's hands will be high, and also on the public sector, there's a slight increase in salaries. And if you go into further extent on this social welfare programs like Aswasuma has also slightly increased. With all those, disposable income levels of the whole economy is expected to increase, and that will cascade down to consumer-driven stocks, which will benefit the consumer sector. And also, I feel, and also it is backed by research, there's a further bit of upside on the banking sector. So those are the main two sectors that I would look at. To some extent, construction also another area. The reason being, you see the construction sector PMI, which are lead indicators, giving better numbers. That is one thing. And also, if you look at the details of the budget, there have been decent allocation on the government infrastructure projects as well. So those are positives on the construction sector. Yeah.
Perfect, sir. Thank you. Right. Just to quickly just let the audience know. So if they are get into an equity fund, what is the minimum investment that they would require to invest? Just to give the audience and how simple it is to start.
So yeah, it's pretty much low as 1,000 rupees. So if you have 1,000 rupees, you can always start investing.
Right, perfect. So yeah, I guess that's about it on the Q&A session. Thank you very much, Surat, for taking your time and coming up with a wonderful presentation and presenting it to the public. To the audience, thank you guys for joining in on Friday evening. So we are planning to host more webinars in time to come. Please do follow our social media channels on updates on the country, on the economy, and as well as the capital markets. So yeah, that's about it from our side as well. Wishing everyone
thank you,
a happy weekend.
Rahul, and thank you, audience.
Right. Until next time, everyone. Bye-bye. Have a great weekend.